Hey there, welcome back to our channel. If you're passionate about investing or just starting to dip your toes into the financial waters, you're in the right place. Today's topic is one that can trip up even the most seasoned investors. We're going to dive into the concept of a bear trap in investing. So, grab your notepad and let's get started. But first, let me ask you this: have you ever felt confident about a market trend, only to see it reverse at the last moment? That's exactly where a bear trap can catch you off guard. So, what exactly is a bear trap? In the simplest terms, a bear trap is a phenomenon in the stock market where a stock or index appears to be heading into a downtrend, prompting investors to sell off their shares or short the stock. However, instead of continuing downward, the stock reverses direction and starts to rise again. This can lead to significant losses for those who acted on the initial downward trend. Let's break this down with an example. Imagine a stock that has been performing well for several months. Suddenly, due to broader market concerns or negative news about the company, the stock begins to decline. The price drops significantly, and many investors panic, deciding to sell off their shares, fearing a larger crash. This situation creates a downward momentum, which might make it look like a bear market is forming. However, after a few days, the stock starts to recover and climb back up. Those who sold during the decline may find themselves regretting their decision as the stock continues to rise, leaving them on the sidelines. This is the bear trap at work. Now, why does this happen? Market psychology plays a huge role in bear traps. When investors see a stock declining, fear takes over. They worry about losing their investment and often make rash decisions to sell, believing they are protecting themselves. But savvy traders who recognize the bear trap can capitalize on this fear. They might buy in during the dip, anticipating the eventual rebound. Let's take a look at some historical data. One notable example occurred during the 2008 financial crisis. Many stocks plummeted in value, but certain companies that were fundamentally strong saw a quick recovery. Those who panicked and sold their shares missed out on significant gains when the market rebounded. To identify a bear trap, investors should watch for certain signs. Key indicators include a sudden drop in stock price, increased trading volume during the decline, and a lack of fundamental news to support the downturn. Often, a stock will test a support level before bouncing back up, which can be a telltale sign of a bear trap. It's also important to be cautious about the broader market trends. If the overall market is in a downtrend, the risk of getting caught in a bear trap increases. Conversely, if the market sentiment is bullish, there's a good chance that a temporary dip could be just that, a temporary dip. Always do your research. Look at the company's fundamentals, industry trends, and market sentiment. Tools like technical analysis can be beneficial for identifying potential bear traps. Analyzing price movements, volume, and levels of support and resistance can give you a clearer picture of what's happening. Bear traps can be particularly challenging for inexperienced investors. It's crucial to remain level-headed and not let emotions dictate your investment strategy. Remember, investing is a long game, and short-term fluctuations shouldn't derail your overall strategy. So, to sum it all up, a bear trap occurs when a stock appears to be in a downward trend, leading investors to sell, only for the stock to reverse and head back up. Understanding this concept can save you from making panic-driven decisions that could hurt your portfolio. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more investing insights. And feel free to leave your thoughts or experiences with bear traps in the comments below. We love hearing from you and learning together. Until next time, happy investing!